Welcome to Digital Asset News. Take the top stories in cryptocurrency and digital assets and break them down into bite-sized pieces. Today, we've got three great stories. First up, the market is pumping, but the real question is why? Also, YouTube suspends Ripple Chief Technical Officer's channel only a week after a lawsuit was filed by Ripple and they sued YouTube, which is interesting. And finally, we're going to take a look at the new Ethereum 2.0 FAQ, or the frequently asked questions, because there's been a lot of questions directed towards me as far as Ethereum 2.0, what that means, how you stake, how it all works, can we buy things, and everything in between. So we'll get to that, but first, let's take a look at the market. So yeah, it's a great day. I mean, look, Bitcoin's up 12%. I mean, this is a pretty fantastic ride, and this is what we are all waiting for. However, is this going to be short-lived? I think it is, but we'll see. But Ethereum's blasted past 200, which I'm happy for. XRP, 20 cents. I mean, everything's up across the board, except Tether, but that's people because they're using Tether to buy into cryptocurrency. So no big news there, but it's a very nice green day, so enjoy it while it lasts. And it could last for days, weeks, months, who knows? I don't know. But I have some theories, and this could play into what's going on with the actual stock market itself. So U.S. stocks rallied on coronavirus news while awaiting the Fed's statement. So what's this all about? Well, this is published today, April 29, 2020. And it states U.S. stocks were trading near sessions high mid-session Wednesday after reports that a drug manufacturer, that's Gilead, clinical trial suggests a treatment to help patients recover more quickly from the COVID-19 disease may be in sight. Fantastic news. The news of the pharmaceutical trial and plans for reopening of economies in the U.S. and Europe helped offset news of a plunge in U.S. first quarter gross domestic product. And I got to tell you, there's been this whole week, these whole months, it's just been like we've just been getting kicked in the teeth, and just over and over and over again. And it's a pain. So when any kind of positivity comes along, people want to grab onto it. And I get it. I mean, I'm excited about it too. It's positive. I like positive news, especially when I can hear about a treatment for the coronavirus. That's amazing. That's huge news. Now, as far as like getting a vaccine, that's way away. But as far as treatment, that's great news for everybody involved. And especially, we're hearing about different reports about the economy opening back up. This is happening in Texas, where I live. This is happening across all the United States. This is happening across Europe. I believe it's happening in Australia as well. Hopefully India. Let me know in the comment section below, because I don't know what's going on in those countries as well. But this is all big news and very positive. So the market is going to react appropriately. So what happened? So investor sentiment received a boost after Gilead Sciences said Wednesday morning that a government-run clinical trial evaluating its experimental drug remdesivir in certain COVID or COVID-19 patients met the study's main goal. Whatever the main goal was, from what I read, these were studies that were being conducted in the Chicago area in different hospitals around, and the whole trial was to determine if you could take patients that are in a high risk or medium to highly contagious area, and how they're reacting to the actual virus, and to see if they could get them not only off ventilators but out of the hospital. And that was the big thing. And from what I had seen before, it looked like it wasn't being very positive, but then all of a sudden we've got news that it is. So great news. The announcement stirred hopes that pharmaceutical companies were making progress toward a treatment of the COVID-19 disease, but investors are still awaiting details from the study, and that's it. So, yeah, I mean, one little thing can turn everything on its head, and it's amazing. I remember, back in March when the WHO said, hey, this is a pandemic. Now, check me on my timeline, but I think it was around that time when they said it, and the market just dropped off the cliff. So now we have different news where, hey, this is very positive, things turn around. But remember, this is just news. This is just small pieces right here. Will it last? I don't think so. You have to remember, this doesn't change the fact that the GDP, the gross domestic product of the United States and around the world, is going to drop off a cliff as well. This slump of the GDP is bigger than the 2000 and 2008 recessions, plus all the quantitative easing as far as money printing. So do I think that Bitcoin's going to go to 50, 100,000 and just keep going up? No, I do not. I think that we're going to see pumps, peaks and valleys, but there's going to be a slow progression, especially after the Bitcoin halving on May 12th. Now, for me, it just doesn't make, it's the same thing. I'm not a trader. I think people that are in my channel realize I'm not a trader. I do not do anything with TA. It's the same thing every week. I put X amount of dollars in my 7 different coins or 7 different products that I believe in. And for those who don't know, so I'm very transparent, here's what I'm into. Bitcoin, Ethereum, XRP, Cardano, Chainlink, EOS, and now Tezos. So when I talk about these things, and if you think I'm biased, you're correct. I am. So that's that. It's never different as far as like what I'm going to do. I'm going to buy things on the way up. I'm going to buy things on the way down. And at some point, I'm going to sell when it hits a certain price point, which if you want to know about that, just watch the Bull Run Basics, and I'll link at the end. And that's it. So the question though is, so why are we talking about traditional markets when we, or you, or who are watching this video, is only into, or mostly into crypto and digital assets, or maybe just curious about it? So why are we talking about traditional markets? It's because if we take a look at the S&P 500 over the last 5 days, we see a nice big fat increase, and that looks pretty good for traditional market players. And look what happened from yesterday when it closed to today when it opened up with that news, and up it went. So what happened in the cryptocurrency market? Kind of the same thing. And I know there's different people who say, well, the traditional market is positively correlated, and then some people say that it's not positively correlated, but I can just tell you today, it's correlated, and I don't see any way around it. Now, tell me where I'm wrong in the comment section. That's fine. We can have that discussion. But from what I'm seeing, it's up across the board. And when we crash, I think we're going to crash across the board. But I could be wrong. Let me know in the comment section. Let's move on. So next up, YouTube suspends Ripple's chief technical officer after a week after Ripple sued YouTube, which is pretty funny to me. Now, if you've been around the channel for a while, you know we do Scam of the Day every so often. Kind of got away from it because there's only so much we can do. We were doing the same scams over and over again. And I was getting very frustrated. And I think Ripple got very frustrated because a lot of our scams that we had reported on and we had been reporting to YouTube say, hey, this is going on. Do your job. You don't have to do much, just do your job. And they wouldn't even do that. And then other people would send me images on Twitter that has these scams being actually promoted, or they were advertisements brought about by YouTube. Because if you're not familiar with YouTube, how it works, YouTube ads, you have to submit every ad that you put through, and they will actually look at those, and some is AI and some is manual review, and they'll say, yeah, this is appropriate or this isn't appropriate. So there's scam ads going through. I think they're still going through today. And that's what Ripple said. You got to stop that because you're hurting not just our brand, but cryptocurrency digital assets as a whole. And I applaud him for it. But here's what happened with David Schwartz. He revealed that YouTube suspended his channel, which goes by the name S. Joel Katz. Schwartz noted that YouTube cited impersonation as the reason for suddenly suspending the channel. What this means is he's banned from accessing, possessing, or creating any other YouTube account. So basically, he is locked out. And that's a bummer, but this does happen. Schwartz has been posting content on his channel for a couple of years now. And I got to tell you, when I read that part, I'm like, well, I could see if it was like a couple of months. I mean, our channel is only like 5 months old. And maybe they'd be like, they're kind of, if I started to do some scammy things, I'd be like, let's shut them down. But, Schwartz here, he's had doing it for years. So it does raise some questions on why he was just suspended. Is it a coincidence, or is YouTube hitting back at the company for the recent lawsuit? And the question's asked, is it just another case of YouTube's crypto purge? If you guys have been around for a while, by the end of December last year, YouTube had censored at least 25 crypto YouTubers. Now, they came back. This was during the holidays, and they said, oh, sorry, it was just a glitch. Our bad. And they fixed it. And, whatever. But it took a couple weeks. But some people were flipping out. I mean, you work real hard as a creator, and then all of a sudden you're like, your channel's gone. and you realize just how much power you don't have. Anyhow, this month, well-known TA or technical analyst Tone Vase was suspended for what YouTube termed as harmful and dangerous content. And correct me if I'm wrong in the comments, but I'm pretty sure he got it back within like 48 hours. And they said again, just a glitch. So two things. First of all, YouTube's got a lot of glitches apparently, and they have a hard time discerning between what's a scam and what's real. Even though on this channel, we've done the heavy lifting and report them, all these scams, and said, hey, we've visually seen these scams and say, these are scams for sure. But I understand, because when I first started my channel and I was big into certain projects and I was not big into TA, I got a lot of hate. And one person said that he reported my channel as a scam. And I was like, well, that's a D move, but whatever. So I think that there's going to be just those people that, report things as scams. So YouTube can't, say, well, that looks a little bit funny. However, if you have a lot of people, let's say over 100 or so who have reported, or maybe even 1,000 who've said, hey, this is a scam, like we've done on this channel for other scam projects, you would think they would look at that a little harder, but they didn't. So there's that. And then I will say this. Sometimes it really is our fault. And I know this isn't a very popular opinion, but it's true. I did a report, and it seems very innocuous right now that I talk about it, but it was where I was talking about a Ethereum-based gaming platform, and they did horse betting. I can't even remember. I cannot even remember the name of the site, but they were doing horse betting. You could bet on virtual horses. I just thought it was interesting, and they struck me down and said, "Hey, we're going to remove this video because it has to do with online gambling. We don't allow that." And it was right there in the rules and regulations, and all that stuff. And I said, "Man." At first, I was livid. I was like, "How dare you censor me?" But then I'm like, oh, it's in your terms and conditions, so there you go. Now, I'm not really happy about that, but they don't allow it, so what are you going to do? The other option is you got your options, which is if you want to play by YouTube's rules, you just go over to Cinnamon or Storybook or whatever else is out there. But yeah, that's the option. So my final thoughts are this. I think YouTube has a heavy hand because of the AI that they use, and they haven't tweaked it the right way. Also, I think that they're not doing their job by evaluating different videos. I will say this, though. For certain videos that get demonetized on my channel, which is very rare, when I submit all the information to them, which is very simple, you just say, hey, that's not true. It takes them a couple hours, and they usually reverse it. So, I mean, so far I've had a pretty good luck. I know others haven't. Let me know what you think in the comment section below. Is this total censorship? Or is this just one of those things where it's just a little mistake? And let's move on. So next up, Ethereum 2.0. Let's break into this. This was a pretty good art. Well, let me say this. Vladislav Sopov, I've read his stuff before, does good work. Here he got lazy. And so he just talks about Joseph Lubin, Ethereum network co-founder and founder of the Consensus Decentralized Web Studio, has published a new FAQ, the future proof of stake version of the Ethereum blockchain. Interesting. And this is his tweet. Great. And then coming down here, this is the whole article. He says, all Ethereum funds will be safe during the transition with no action required from holders. Also, the Consensus team highlights that there is currently no possibility of buying ETH to Ethers. Okay, that's good. And then he talks about Consensus Studio. It's a decentralized team. They've contributed to the development of ETH 2.0. Their building efforts are focused on 3 instruments. The first one is CodeFi Activate, which helps retail stakers participate in the validation process. And then they do CodeFi Networks, which is a staking as a service, will act as for institutional staking products, blah, 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 blah. Okay, and that's it. So I read that and I was like, all right, where's the rest? I'm like, that's it. That sucks. So here's the thing. Like I said, this gentleman here, Vladislav, he usually does good work. But I think he's probably been covering this so much, he's like, everybody knows this stuff, right? Well, I don't know this. I think some of you don't know this either. So let's take a look at Ethereum 2.0, the FAQ, and really dig into it and get into the meat and potatoes of what this is all about. Sometimes people have what's called the curse of knowledge. They just know so much and they talk about it so much, like, well, you all know that. Well, I don't know it, so let's fix that. So first off, What's Ethereum 2.0? Well, Ethereum 2.0 is called Serenity. Great. What's the difference between ETH 1 and ETH 2.0? So, first I'm going to read it, and then we're going to go and look at some animations and some graphics because I'm a big picture person. I need descriptions just as a base, but I need to visually see it. I'm a visually focused, and I think some of you are too, so that's why I always back things up with some type of visual representation. So first up, proof of stake. Proof of stake, and I like how they said this, it's an upgrade which enables improved security, scalability, and energy efficiency. Instead of relying on physical miners and electricity, POS, which I always kind of laugh at that, but it's proof of stake. It's POS relies on validators, or virtual miners, and deposits of Ether. So that's proof of stake. So they're going to go from proof of work, right? Mining, which we're all pretty familiar with. Some of us are, most of us are. If you're not, go ahead and check my playlist. I'll explain that in there. And they're going to go from proof of work to proof of stake. So no more miners, no more electricity use. It's very efficient, they say, and relies on validators. Great. Then they're going to do this other thing called shard chains. So there's really just two big things, proof of stake and shard. So shard chains are a scalability mechanism which drastically improves the throughput of the Ethereum blockchain. Currently, having a single chain made up of consecutive blocks is incredibly secure. That's true. It makes information very easy to verify. Also true. However, requiring each full node to process and validate each transaction affects the ability to process transactions quickly, and it makes it super expensive, especially in times of high mainnet activity. So I'm going to give you an example. In 2017, when I first got into it, Bitcoin was cheap, super cheap, kind of fast. And then when everybody got into it, it just clogged up the system and it was super slow. It would take over a day to do a transaction. And then the fees went from like, I don't know, I mean, depending on how much you move, a dime, 15 cents to like, there was like hundreds of dollars of fees that I heard about. It was crazy. So that didn't work out so hot over there. So shard chains are a mechanism which Ethereum blockchain is split, dividing the processing responsibility among many nodes. This allows for transactions to be processed in parallel rather than consecutively. Each shard chain is like adding another lane to upgrade Ethereum from a single lane road to a multiple lane highway. So it's kind of like we're going for, okay, we've got one blockchain, which is just a dirt country road. I shouldn't say it like that. Kind of disrespectful. We're going to go from one dirt country road to a major highway, 4 to 8 different lanes, super fast, super efficient. That's apparently what sharding is. And sharding chains are expected to be rolled out in phase 1 of Ethereum 2.0. So that's great. It's great that we talked about that. Let's see what the heck that is. So this is sharding. It's a 3-minute, 3.5 minute or so after we do some skips of what it is. And like I said, I like videos and animations because it helps me visualize everything. Let's take a look.
Scalability has been a perennial stumbling block for blockchain, the much-hyped distributed ledger technology. That's because as a blockchain grows, so too does the amount of data stored on each computer in the peer-to-peer network. It's a critical issue because blockchain has outgrown its cryptocurrency roots and is now poised to reshape supply chains, parts of the fintech world, real estate, and a host of other industries. To achieve its full potential, blockchain has to be able to grow exponentially without becoming too slow or bogging down the computers on which it runs. That means making it scalable. And that's where sharding comes in. Sharding is one of several methods being tested by startups, developers, and current blockchain platforms such as Ethereum to see if it can help blockchain developers finally climb the scalability mountain. To understand sharding and how it might help, you first have to understand a little more about blockchains. One of the main problems with public blockchains involves something called consensus protocols based on proof of work. This is what underlies how transactions are authenticated. A majority of the blockchain users have to agree that proposed transactions are authentic and can be added to the chain. In other words, there has to be a consensus. But consensus algorithms used by the likes of Bitcoin and the Ethereum payment network are highly compute intensive. They use a lot of CPU cycles. Further complicating things, proof-of-work-based blockchains require each authenticating computer or node to record all the data on the chain because it's part of the consensus process. But as more transactions occur and the blockchain grows, more computing cycles are needed, and everything slows down. How slow? Well, Bitcoin can only process 3.327 transactions per second, and a single transaction can take 10 minutes to complete. Ethereum is a little faster. It can process from 12 to 30 transactions per second. But that's nothing compared to Visa's 50-year-old electronic payment network, VisaNet. It processes around 1,700 transactions a second. In order to compete with VisaNet and other conventional networks in terms of scalability and performance, blockchain needs turbocharging. That's where Sharding comes in. It's been around for a while. Originally designed for horizontal database partitioning, Sharding is a way of spreading out the computing and storage workload from a blockchain's network so that each node no longer has to process the entire network's transactional load. Each node only maintains the info related to its specific partition, or shard. Sharding allows a blockchain to remain decentralized and secure, two of the things that make it so popular. The information in a shard can still be shared, and everyone can see all the ledger entries. But every node is freed from recording and storing all data on every other node. That allows data to be stored more quickly and makes it easier to find because its location is mapped on the blockchain. Because fewer nodes now see and process transactions, more transactions can be processed in parallel. While sharding could be the key to allowing blockchains to scale securely, hurdles remain. For one, if you're going to maintain blockchain security, you have to guard against what are called shard takeovers. Corrupting the nodes in a given shard will lead to the permanent loss of data. That would be very bad. Ethereum tackles the security issue by randomly assigning a node to a shard, and then randomly reassigning those nodes to other shards. A second challenge involves thin clients, also called SPV, Simplified Payment Verification Wallets, and ensuring that nodes have the full picture of the blockchain's current state while it's divided among shards. To address that issue, thin clients communicate via separate networks and maintain local state copies for each shard. And finally, it's important to note that inter-shard communication, while good for security, still poses a challenge because each shard appears as a separate blockchain network. So you can see that while sharding has the potential to eliminate a lot of the scaling problems blockchain has, it's still very much in the development and testing phase, pretty much like
So anyhow, that's the whole thing right there. Now, what it sounds like to me is that Ethereum, as great as sharding is, has figured out all these little issues where it talked about shard takeovers and thin clients. So what the big question then is, okay, now we talked about sharding and I get it. So how is it going to work with the staking? Because proof of work is what I know. What's proof of stake? How's it going to work on Ethereum? So let's take a listen. This is another graphic representation, which should help you to understand what is going on with this proof of work to proof of stake, the advantages, disadvantages, and why I think it can be very huge.
In 2011, a Bitcoin Talk forum user called Quantum Mechanic proposed a new technique that he called proof of stake. The basic idea is that letting everyone compete against each other with mining is just wasteful. So instead, proof of work uses an election process in which one node is randomly chosen to validate the next block. Oh yeah, small difference in terminology here. Proof of stake has no miners, but instead has validators. And it doesn't let people mine new blocks, but instead mint or forge new blocks. Validators aren't chosen completely randomly. To become a validator, a node has to deposit a certain amount of coins into the network as stake. You can think of this as a security deposit. The size of the stake determines the chances of a validator to be chosen to forge the next block. It's a linear correlation. Let's say Bob deposits $100 into the network, while Alice deposits $1,000. Alice now has a 10 times higher chance of being chosen to forge the next block. This might not seem fair because it favors the rich, but in reality it's more fair compared to proof of work. With proof of work, rich people can enjoy the power of economies at scale. The price they pay for mining equipment and electricity doesn't go up in a linear fashion. Instead, the more they buy, the better prices they can get. But back to proof of stake. If a node is chosen to validate the next block, he'll check if all the transactions within it are indeed valid. And if everything checks out, the node signs off on the block and adds it to the blockchain. As a reward, the node receives the fees that are associated with the transactions inside this block. Okay, but how can we trust other validators on the network? Well, that's where the stake comes in. Validators will lose a part of their stake if they approve fraudulent transactions. As long as the stake is higher than what the validator gets from the transaction fees, we can trust them to correctly do their job. Because if not, they'll lose more money than they'll gain. It's a financial motivator and holds up as long as the stake is higher than the sum of all the transaction fees. If a node stops being a validator, his stake plus all the transaction fees that he got will be released after a certain period of time. Not straight away, because the network still needs to be able to punish you should they discover that some of your blocks were actually fraudulent. So the difference between proof of work and proof of stake are quite significant. Proof of stake doesn't let everyone mine for new blocks and therefore uses considerably less energy. It's also more decentralized. How is that? Well, in proof of work, we have something called mining pools. Those are people who are teaming up to increase their chances of mining a new block and thus collecting a reward. However, these pools now control large portions of the Bitcoin blockchain. They centralize the mining process, and that could be very dangerous. If the three biggest mining pools would merge together, they would have a majority in the network and could start approving fraudulent transactions. Another important advantage is that setting up a node for a proof of stake based blockchain is a lot less expensive compared to a proof of work based one. You don't need expensive mining equipment, and thus proof of stake encourages more people to set up a node, making the network more decentralized and also more secure. But even proof of stake isn't perfect, and it also has some flaws. Now you might think, hold on a minute, if I buy a majority stake in the network, I can effectively control it and approve fake transactions. And you would be correct. This is called the 51% attack, and it was first discussed as a weak point of the proof of work algorithm. If a single miner or group of miners can obtain 51% of the hashing power, they can effectively control the blockchain. Proof of stake, on the other hand, makes this attack very impractical depending on the value of a cryptocurrency. If Bitcoin would be converted to proof of stake, acquiring 51% of all the coins would set you back a whopping $79 billion. So the 51% is actually less likely to happen with proof of stake. But that's not the only risk. Proof of stake algorithms also have to be careful how they select the next validator. It cannot be completely random because the size of the stake has to be factored in. But at the same time, the stake alone isn't enough because that will favor rich people who will get chosen more frequently, will collect more transaction fees, become even richer, and thus increase their chances of being chosen as a validator even further. There are a number of proposals to fix this, like coin age-based selection, for instance. Another potential problem is when the network chooses the next validator, but he doesn't turn up to do his job. This could easily be solved by choosing a large number of backup validators as a fallback. In short, proof of stake brings additional risks when compared to proof of work, and a lot of research is needed to understand these risks and then to mitigate them.
Okay, and that's it in a nutshell. So I know that was kind of long, but I felt it was good information because some of you know this. Some of you know this like the back of your hand, and some of you this is totally new. So we have to start from the base level. So I hope that helped out. There is one piece that I want to make mention, and that's when they talked about the 51% attack and different miners if they merge together. Now, there's a big difference between mining pools and individual miners. So a miner will join these mining pools because it is economically important for them to do so, because to mine Bitcoin these days by yourself in your apartment with your one mining rig is impossible. So what's happening is a lot of these mining pools are centralized in China. And there was a article that we talked about, or a story you talked about yesterday on this channel, which said that in Ya'an, I think it's how you say it, they are offering extremely cheap electricity. I mean, like super, super duper cheap. And that's what the Chinese government has done. They said, hey, we're going to drop down this hydroelectric power, and we want to attract miners here for quote unquote blockchain, which is really Bitcoin. And what's going to happen, it's going to attract all the different miners globally into that mining pool, and all those mining pools are in China. So I understand that miners, they can go anywhere they want to, but where are you going to go? Because as the Bitcoin halving comes up on May 12th, May 13th, somewhere around there, and then the rewards is cut in half, and the cost of electricity still remains the same, or maybe has increased in your area, why wouldn't you do the other thing? Now, I could be wrong in my assessment here. Let me know in the comment section, but that's my 2 cents for that piece. But I hope the proof of work and proof of stake helped. Let's now jump back to the FAQ, and it's going to make a lot more sense as we go through everything. So let's talk about time frame. So there's ETH. So the Ethereum 2.0 is going to be rolled out in 3 phases. Phase 0, 1, and 2. So phase 0 is going to launch in Q3 of 2020. No, sorry, Q2 of 2020. That's what it's supposed to be. So January, February, March, the first quarter. And then you got April, May, June for the second quarter. So this is when it's going to get rolled out. With phases 1 and 2 to be released in the following years, I believe it's all going to be hit its crescendo next year. So phase 0 will be Beacon Chain will be implemented. The Beacon Chain stores and manages the registry of validators and will implement the proof of stake. So bam, already coming fast. The original Ethereum proof of work chain will continue to run alongside the new Ethereum proof of stake chain, ensuring there is no break in data continuity. So you don't have to do anything. It's all going to happen in the background. Phase 1 will roll out in 2021. Phase 1 is the integration of shard chains. So we got proof of stake coming up pretty fast. Then they got the shard chains in phase 1, which is in 2021. Then phase 2, 2021 or 2022. So I stand corrected. So phase 2 will be implementing cross shard transfers and contract calls, building execution environments so that scalable applications can be built on top of Ethereum 2.0, and bringing the Ethereum 1.0 chain into Ethereum 2.0 so that proof of work can finally be turned off. So you see how it all works. So bam, it's going to be proof of stake. Then it'll be sharding, and then they're going to optimize everything to make sure it can be built on it and just build it all up. And that's going to happen over the next 2 years. Now, again, Ethereum sometimes has a little bit of a thing about hitting their milestones. So let's see if they can do that. Be interesting. So now let's talk about what will change when Ethereum 2.0 is completed. So Ethereum 2.0 will not eliminate any of the data history, transaction records, or asset ownership of the Ethereum 1.0 chains. The Beacon chain, which will be the backbone of Ethereum 2.0, will be fully functional with the existing 1.0 chain, ensuring continuity. So don't worry about losing anything. You just don't have to do anything right now. Just keep your Ethereum. So next up, let's talk about, because the other ones don't really say it too much. I've already read them. This one goes to what is the Ethereum proof of stake, and this really gets into validators. So proof of stake is an upgrade, what we just talked about. It relies on validators and staked ETH for the continuation of blocks in the blockchain and is necessary for sharding. Validators are people who elect to continue the blockchain by depositing or staking 32 ETH into the deposit contract. That's the magic number. That's why everybody talks about getting 32 ETH. Now, I believe that when you lock up these 32 ETH, they're locked up for like 6 months or longer. So just be aware. Validators are randomly selected from the pool. Should a validator successfully validate a block, they will receive an ETH reward. Awesome, just like we saw in the video. If a validator attempts to compromise the truthful continuation of the blockchain, their deposit will be slashed. What does that mean? It means they'll lose some or all of their 32 staked ETH. So imagine trying to screw the system and they just take all your ETH. Like, sorry, do not pass go, do not collect $100. We're going to take all your money, all your Ethereum back, so don't screw us. Makes sense. Staking on Ethereum 2.0 will only require a consumer laptop. Wow. And some software clients aim to be lightweight enough to run on a cell phone. Proof of stake will go live in phase 0. Then it talks about, can I buy Ethereum 2.0? There's no way to buy Ethereum 2.0 Ether right now, since there will not be a new type of ETH token. That's good news. Users will deposit ETH in the Ethereum 2.0 deposit contract, and right now this is planned to be a one-way, non-reversible transaction. So when this all comes about, you'll be able to put it into the contract and spits it all out. There are 2 ways ETH holders can participate and earn rewards for staking. First, an ETH holder may run their own validator by increments of 32. Another option is to stake their rewards through a staking provider or join a staking pool with a smaller amounts of ETH through which anyone can stake whatever small amount, blah, blah, blah. So kind of like how Tezos does it, right? You can either be a baker and, be your own person, or you can just kind of join up with that baker and go, here, just take my Tezos and give me my money later on. And that's how it works. And then last up, the rest of the stuff kind of repeats. It repeats a lot, actually. But the last question I had, which is what I thought would be interesting, just to reconfirm, is what happens to ETH I own now. So just to be sure, there's no need to do anything special with the ETH you currently own. It continues to be fully usable on the Ethereum 1.0 chain. At some point, the Ethereum 1.0 will become part of Ethereum 2.0, and your ETH will continue to function just as it does now, with no action required on your part whatsoever. So that is it in a nutshell. I see big things with Ethereum, and especially with this proof of stake. Wow. Sharding, we'll see how it works out. I mean, just like we saw in the video, there are advantages and disadvantages. Let's see if these really smart people at Ethereum, they've actually figured it all out. We'll find out. All right, that's it. I know that was long, but it was a lot of good information for Ethereum 2.0. Hopefully we won't go so long again. And that's it. So thanks for watching. Appreciate it. If you like these types of videos, there's going to be 2 more coming up on your left and right. And that's all for today. So thanks for watching. See you on the next one.